Breaking news on Martyn Lucas Investor. We are looking at the Fed cutting rates ending QT, which is massive, but Jerome Powell came out yesterday and he signaled that the December decision is not a sure thing. That brought the markets down. The markets are coming down a little bit this morning. Trump met Xi Jinping yesterday. Deals were made. 3 earnings were reported as well. Meta, Microsoft, and Google. Google beat on earnings. Their AI investment was great. It's returning capital. Microsoft down only slightly because of the amount of spending they're doing on AI. Same with Meta, but Meta took a $15 billion tax hit. And also Mark Zuckerberg said that their spending was more than expected. And he wasn't saying that in a bad way, but Meta took that as or investors took that as a reason to sell it off. Remember, I said market's price for perfection. We didn't really get perfection with those earnings, but we got pretty close. We didn't really get perfection with the China deal, but we got very, very close. Trump rated it a 12 out of 10 in how happy he was with the meeting. It was the Blackwell chips from NVIDIA that we didn't get that final view on. But here is yesterday's this is the analysis of yesterday's FOMC meeting with Jerome Powell and the Q&A. I'll break it down in this video, so please do make sure you have hit the like button. Make sure you have subscribed as well. So, Fed cuts rates, ends QT, signals December decision is not a sure thing. When he said that, the markets came down because everyone is pricing in a December rate cut, but he did make it clear that there possibly won't be one. So, the Federal Reserve delivered a 25 basis point rate cut. We got the rate cut. We expected 25 basis point. We got it. The second consecutive move, lowering the federal funds rate to 3.75 to 4% and announcing the formal end of QT, quantitative tightening, effective December the 1st. Major news there. Together, these steps mark a decisive policy pivot after nearly 2 years of tightening aimed at addressing what Chair Jerome Powell calls elevated inflation risk on the upside and rising employment risk on the downside. So, let's start with the monetary policy rate cut and a divided path, because initially we got the rate cut decision, 25 basis point. We knew that, but what we got was there was a divided Fed. Some wanted more, some wanted less. That shows division, and the market didn't like that. So the FOMC vote was a 10-2, with one member preferring a larger 50 basis point cut and another calling for no change. An unusually wide split that underscores internal uncertainty. Powell said the move reflects downside risks to employment as job gains have slowed significantly, driven by lower labor force participation and weaker immigration. He's not saying people are doing layoffs, even though we're starting to see more and more layoffs, but he's not saying that's the reason. He's saying the reason is because of people hiring and also weaker immigration. He emphasized that the committee's goal is to support demand at the margin without reigniting inflation, positioning policy within the 3 to 4 neutral range. That's where we are now. We are very close to neutral range, according to him. That basically means they won't do any more rate cuts once we hit the neutral range, or whatever they think is the right neutral range. Powell also cautioned that December rate cut is not a foregone conclusion. He said it's far from it. He didn't just say, like he always says, we don't talk about future rate cuts. He said the extra wording, which was, and he said this a few times, is far from confirmed or far from having a December rate cut, which the market priced in. He cited the ongoing government shutdown, which has disrupted official employment and CPI reporting as a key reason for patience. He then said, when you're driving in the fog, you slow down. Again, a bit of a hawkish stance there. While some officials favour continued easing, others want to assess whether strong Q4 data reflects real underlying demand or temporary effects. Those were the two main hawkish things he said. Everything else was pretty dovish that Jerome Powell says. The main ones was when you're driving in the fog, you slow down. The other one was it's not a foregone conclusion, far from it. That's when he was talking about the December rate cut. If we talk about the balance sheet as well, QT ends, reinvestment begins. If you are still watching, please make sure you hit the like button and subscribe. The Federal Reserve confirmed that its balance sheet runoff, known as quantitative tightening, will officially end on December the 1st. That was a really good announcement we got, concluding 2 years two-year process of monetary balance sheet reduction. Since 2022, the Fed has shrunk its holdings by 2.2 trillion, reducing balance sheet from 35% of GDP to about 21%. QT is essentially, if no one knows what quantitative tightening is, it is essentially the inverse of quantitative easing. Quantitative easing is obviously what's good for the markets. Quantitative tightening is the markets don't see it as a real liquidity injection. So with QT, rather than injecting liquidity by buying bonds, so buying up bonds, injecting liquidity in the markets, the Fed actually allows assets like treasuries and mortgage-backed securities to mature without reinvestment, gradually draining liquidity from the financial system. The goal is to tighten financial conditions, curb inflationary pressures, and restore flexibility to the monetary policy after years of stimulus. Chair Jerome Powell said that the decision to halt quantitative tightening came after signs of tighter funding markets, including elevated repo borrowing and higher short-term rates, which suggested that the bank's reserves had reached ample levels. Ending QT means that the Fed will not hold its balance sheet steady, preventing further liquidity drain. Under its new reinvestment strategy, maturing agency mortgage securities will continue to roll off, but proceeds will be reinvested into Treasury bills, a move aimed at shortening portfolio duration and aligning maturities with the broader Treasury market. For markets, the end of QT typically eases upward pressure on yields and supports risk assets as liquidity conditions stabilize and investors anticipate slower pace of monetary tightening ahead. So this is historically QT ends. That means more money can flow into the system. That upwards pressure on yields softens, so that supports risky assets, stock market, crypto. So that was one major announcement. Then he talked about inflation tariffs, a one-time price adjustment. And this is what we wanted to hear. We said if we hear him talk about inflation, let's hope he talks about it being a one-time price adjustment. So Powell reiterated that the recent inflation upticks are mainly due to tariff effects, describing them as a one-time shift in price levels rather than a new inflation cycle. Headline and core PCE inflation both rose 2.8% year on year through September, but the Fed expects tariff inflation to only add 0.2 to 0.4 percentage points through spring before fading. Excluding tariffs, Powell said inflation is not too far from 2%. He acknowledged lingering consumer frustration, noting that prices remain much higher than they were 2 or 3 years ago, even as disinflation progresses. So essentially, these tariffs, don't worry about them. They're going to hit us once. There's no point adjusting policy for them. Actually, if you take away tariffs from where inflation is, we're very close to our 2% target. So it was quite bullish and dovish what he said there. He then, Powell's tone was measured, deliberate, and risk aware. He framed the current stance as a neutral recalibration, neither stimulative nor restrictive, and emphasized data dependency amidst uncertainty caused by the federal shutdown. His repeated references to caution driving in the fog signal that the Fed will slow its decision pace, prioritizing stability and flexibility over pre-commitment. Markets interpreted this tone as dovish but pragmatic. Bond yields eased modestly, the dollar softened, equities futures firmed on expectations of liquidity floor forming into year end. So yeah, that was the parts of the tone. If you look at some of the quotes he said as well, or some of the things that occurred because of this, end of the balance sheet runoff, end of QT, that's dovish. Emphasis on rising employment risk, that's dovish, because obviously that means cut rates. Neutral stance and balanced approach, dovish. He did say if you're driving in the fog, you slow down. That's slightly hawkish, indicates caution. Tariff inflation likely one time. That's dovish. They're not going to adjust policy because of tariffs, and they think it's not going to cause major inflation. Acknowledgement of AI-related layoffs and weaker hiring. That means he's worried about the jobs market, so that's dovish. That means rate cuts. The slightly hawkish part was when he said December cut. It's not a foregone conclusion. Kept talking about that December cut as don't count on it. That's slightly hawkish because everyone's pricing in a December cut. And then he then said policy is near neutral rate, 3 to 4%. We are now in that rate. Remember that neutral rate is when they don't cut anymore. They're very happy. It's serving both sides of it, and that could mean we get no more rate cuts for a year, or it could mean we only get 2 or 3 more rate cuts in 2026. That's going to be the debate going forward. Some of the key quotes: "We decided to lower our policy interest by 1/4 percentage point." That was the decision. Obviously, the end of Q2, December the 1st. Job gains has slowed significantly since earlier in the year. He's acknowledging the labour market while he's cutting rates. Downside risks to employment appear to have risen in recent months. He suggests the Fed is more concerned about job losses than sticky inflation. Again, if they're concerned about inflation, they'll keep rates where they are. Because they're concerned about job losses, they're going to reduce rates. If job creation, once you adjust for overcounting, is close to zero, then maximum unemployment is not sustainable. He's hinting at internal analysis showing labour market may be closer to recessionary risks than the official data implies. So the data we're getting might not be showing the whole picture. Again, that's dovish because it means they should cut rates. But if we go into recession, then who cares about rate cuts at that point? Rate cuts aren't going to save the market. At that point, we'll be in a recession territory. We are now in the range that many estimates are neutral, between 3 and 4%. So again, it looks like we're coming to a neutral rate. Yeah, those are the main ones we've already covered. So the bottom line is that the October FOMC meeting marks a turning point. The Fed ended QT, they lowered rates and shifted towards a neutral data-driven policy amid rising labour market risks and constrained data visibility. Powell's tone was cautious but steady, suggesting a pause in December is likely. But not guaranteed, as the Fed navigates the final stretch of its tightening cycle while trying to preserve market stability. So we will keep an eye on the markets. We'll keep you up to date with all. But that was a full analysis of yesterday's FOMC. I'll put the speech over here. So if you haven't seen the speech yet, I've condensed it, and the speech will be over there. There'll be a playlist up here. There'll be the newsletter over here if you haven't got the newsletter yet. First link in the description as well. But until next time, take care of yourselves and each other.